Welcome back to Outlook 2024. Our economists expect that growth is going to slow down a wee bit. But the big cat among the pigeons is going to be this bond index inclusion, which could bring in well over 2 lakh crores. And who is to say that we may not be included in the Barclays Bloomberg index as well? And will that mean more inflows? What does that do to the rupee and to interest rates? I have with me Neeraj Gambhir of Axis, Sakshi Gupta of HDFC, Samiran Chakrabarty of Citi, and Santanu Sengupta of Goldman to discuss all that. Gentlemen and Sakshi, thank you very much for your patience. Sakshi, just that. What is the Reserve Bank expect to do when this money flows in? Do you expect MSS bonds, etc.? And what will it do to interest rates and the rupee?
Lata, clearly the central bank over the last 2 years has maintained the strategy of, building up their reserves. They have been, absorbing a lot of dollar flows. Their intervention on the rupee has been two-sided. And, more recently we've seen that despite the appreciation we've seen in some of our peers, the rupee did not see, a similar amount of appreciation. And that's perhaps due to RBI intervention. I think that going forward, clearly, yes, with the sheer amount of inflows that are going to come in, both because of the inclusion in the bond index, as well as some amount of, positivity towards India and the emerging market basket, we could see, an appreciation bias for the rupee.
Okay.
That being said, I think that the RBI will continue to intervene and absorb some of these dollar inflows, because I don't think that they would want significant amount of volatility, be it appreciation or depreciation, to come in. So I think that we will see foreign exchange reserves from the central bank go up further next year, and I don't think that the rupee would appreciate by a significant amount, although there will be an appreciation bias. But I think that we will see some amount of resistance coming in from RBI's intervention of absorbing a lot of these flows.
Okay. I know it's a tough thing to guess, Sakshi, thanks for that. But Samiran, actually a similar question to you. Do you expect that the Reserve Bank may have to take recourse to, MSS or something? Or how will it tackle the likely flow of money? And, we've been used to this 83.30 for God knows how long. So I can't even believe there will be a rupee appreciation right now.
But in our view, what's happening is that RBI is putting almost equal emphasis on three things: price stability, financial stability, and currency stability. And that's why we are seeing this exceptionally low volatility in the INR markets. We don't think that's going to change in a very dramatic way in 2024, because RBI has both the willingness as well as the ability to maintain this, given the kind of FX reserves that they have. And luckily for us, if our DXY view is correct, that the range for the year is between 102 to 107, then there's no need for a big rupee move to adjust for valuation concerns. Okay. Even the inflation differentials would not suggest something like that. So the RBI can keep on having a relatively tighter range on the currency. But on your other question on sterilization of these inflows that are going to come, our sense is that about 1 to 1.5 trillion of OMO sales could be required, or MSS bonds could be required, on very tentative assumptions about a small reduction in fiscal deficit for next year. Then also there will be enough demand for the borrowing to clear in the market.
Oh, there should be enough demand now that there is another giant set of, investors coming in. Shantanu, just a word on flows and on current account deficit. Current account deficit is not a problem now, but if the world were to slow, would you say that export growth as well as services, as it is, our services exports are only at 28 billion for the last, 9-10 months of this year? They're not growing. Likewise, goods exports, it's around 33 billion. It's not growing beyond that. So, will that be, will we see export growth? And more importantly, what do you say in terms of capital flows?
Yeah, sure, Lata. So firstly, on the export side, services exports was doing about 7% of GDP on average pre-pandemic period. It does anywhere between 9 to 10% of GDP now. Call it 9.5.
Okay.
That is already giving you a buffer. We don't think that that grows much beyond in terms of percentage of GDP. So it's reached a peak in terms of percentage of GDP. But even then, it cushions the current account deficit, that you're running from more the merchandise trade balance side. Added to that, you're having about $100 billion of remittances. We think that the current account deficit will be less than 1.5% of GDP. We have a 1.3% of GDP projection for 2024. On flows, I think the global rates view changing is quite material, right? Because that creates this risk-on scenario for emerging markets. And therefore, we would expect robust capital flows. One, equity flows probably continues to remain robust with the Fed stance changing. Two, we talked about the GBIM bond inclusion and therefore debt flows. And three, FDI, which has been quite slow this year, will probably turn around also as cost of capital in the dollar markets come down, because fundraising was difficult for private markets with dollar rates at 5.5%. Once that starts easing, you will find more FDI flows as well. So what that will do is that instead of looking at just the GBIM bond inclusion flow in isolation, you'll probably end up with anywhere between $25 to $30 billion of balance of payment surplus, if our assumptions on the current account is right. And that's what the RBI really has to deal with in terms of absorption. Our view is that they go ahead and absorb the flows. They continue to build reserves and treat domestic monetary policy separately. So they'll sterilize or not sterilize depending on what their domestic monetary policy requirements are.
Samiran, it's just that consumption hasn't picked up. I can see that even in the forecast of you and Santanu and Sakshi, that people will invest. CapEx will grow ultimately if consumption grows. And the K-shaped recovery seems clearly not leading to that. Do you think that will come? And more importantly, do you think tax to GDP ratio is rising so much that the government can do both CapEx as well as do a lot of income transfers?
I'll try to be brief. On consumption side, I think we are seeing some slowdown trends in urban consumption, while there are some green shoots on the rural side. I don't want to overemphasize them and wait to see how the Rabi crop performs before calling for a full-fledged rural recovery. But hopefully with the rural picking up, we see some overall improvement in consumption. But you are absolutely right that finally the private capex recovery should lead to more job growth, more income growth, and that would be a more durable basis for consumption growth. And the tax to GDP part, I think the problem is not so much the tax to GDP. The challenge for the government is to reduce the fiscal deficit from 5.9% of GDP to 4.5% of GDP in 2 years' time. That's 70 basis point of correction every year. And if you look at the pre-pandemic versus the current fiscal numbers, what strikes you is that the entire sort of increase in fiscal deficit is coming because of capex to GDP increasing from 1.7% to 3.3%. That's a good quality expenditure you don't want to reduce. And to reduce the revenue expenditure or to increase the tax to GDP substantially is going to be a very challenging task. There is a silver bullet always, which is divestment, asset monetization, etc., which can plug this hole. But overall, it's difficult to sustain this kind of expenditure growth with this deficit reduction target in mind.
Thank you very much, Samiran, and thank you all of you for packing in so much in such a short time. The important message is growth will be a little slower, but at 6.2%, we will still be one of the fastest growing economies and definitely the fastest growing large economy in the world. But it'll be an interesting year with possible rate cuts from the Fed and a huge bond-related inflow into the country. Thank you very much for watching this special edition of Outlook 2024 Indian Economy.